Welcome to the FGS 2011 Budget Webcast. Less than a fortnight ago, we issued a special edition of our newsletter, Tax Talk, setting out the principal features of the government's four-year plan. We said then the government would leave no stone unturned in trying to cut expenditure and collect additional revenue in order to meet its €15 billion target. Today we saw what lay beneath some of those stones. This year's budget is extremely wide-ranging. Later, my colleagues, Michael McGivern and John Fisher, will take you through the key measures affecting individuals and businesses. But first, I would like to touch briefly on some of the changes. A budget would not be a budget without some of the old faithfuls, and so petrol goes up by 4 cents a litre and diesel by 2 cents a litre from midnight. Alcohol and cigarettes were not touched. Stress relief is still required. The air travel tax, which has had so much media attention, will be reduced to €3 from the 1st of March, but the government will review this at the end of 2011. On the capital taxes front, the capital acquisitions tax thresholds are to be reduced by 20% for gifts and inheritances taken from midnight. These are significant reductions, bringing the thresholds almost back to 2001 levels. Stamp duty on residential properties has been simplified radically. Buyers will pay 1% stamp duty on properties valued up to $1 million and 2% beyond that. Furthermore, many reliefs, such as first-time buyer relief, are being abolished. Savers are not spared either. DIRT, the deposit interest retention tax, will rise to 27% for normal deposits and 30% for long-term deposits from the 1st of January. Pensions are subject to significant change this year. Employee contributions will no longer be free of PRSI or the new universal charge. For employer contributions, the PRSI exemption will be removed from 50% of contributions from the 1st of January 2011. As flagged in the four-year plan, the annual earnings limit for tax relief and pension contributions was cut from €150,000 to €115,000. But the budget brought a sting in the tail, as this new lower limit will apply retrospectively to 2010 for some people. The maximum allowable pension fund for tax purposes is to be capped at $2.3 million, which represents a 58% reduction on the current level. The maximum tax-free lump sum anyone can take on retirement will be €200,000. Those who draw down more will have to pay the standard rate of income tax, currently 20%, and may have to pay the top rate if the total lump sum exceeds €775,000. The mandatory annual income from ARFs rises to 5% from 3%. This seems counterproductive given the government's commitment to make retirement options flexible for more people. Given the cut in incomes from increased taxation and the new pension restrictions, it's going to be a case of retirement, but not as we know it. I now hand you over to my colleagues, Michael McGivern and John Fisher, to take you through the other aspects of Budget 2011.
Hello, I'm Michael McGivern. I'm a tax partner here at FGS, and over the next few minutes I'd like to highlight some of the main personal tax measures from Budget 2011. From a tax perspective, we have to consider this budget in the context of the recently published four-year plan. In the plan, the government proposes to save $10 billion by cutting expenditure and raise $5 billion more, mainly through taxation. The plan says it's unsustainable for 45% of earners to pay no income tax, so the tax base needs to be broadened. The government also said it wants to restrict or abolish some tax reliefs so higher earners cannot shelter themselves from paying what the government regards as their fair share of tax. In the budget speech, Minister Lenihan again repeated a point made in the plan that there is an imbalance whereby just 8% of taxpayers currently pay 60% of all income tax, while almost 80% contribute just 17%. He followed through on the plan's proposal to bring the income tax system back to 2006 levels by announcing a 10% reduction in both personal tax credits and rate bands from 1 January 2011. Furthermore, the budget proposes the abolition of the PRSI ceiling of approximately €75,000 for employees and proposes an increase in the Class S self-employed rate from 3% to 4%. In last year's budget, the Minister said the income levy, the health levy and PRSI would be merged into a new charge, and this budget starts that process. The health levy and income levy will be abolished and replaced by a new universal social charge from 2011. The universal social charge rates for 2011 are set at such a rate to ensure they are revenue neutral. The plan proposed the abolition of 10 tax reliefs, with a further 6 to go in Budget 2011. However, the Minister went further and announced the abolition or restriction of a further 9 reliefs, bringing the total to 25. My colleague John Fisher highlights some noteworthy changes in this area to business reliefs later in this webcast. However, one deserving of special comment is the proposed phased abolition of property reliefs. The measures announced are severe, and we think they will have significant consequences for many property-based investments where the availability of these reliefs has been factored into both deal pricing and debt repayment commitments. Section 23 relief has been radically restricted. Separately, passive investors have also been severely hit by changes to the capital allowances regime relating to property investment. These include the loss of unused allowances in certain cases and the restriction of capital allowances to income from the property concerned. The budget confirms all unclaimed and unused capital allowances and all unused Section 23 relief will be lost after 2014. Finally, it's worth noting the following issues which are contained in the plan but which were not mentioned in the budget, although of course the plan could change with a change in government. VAT will be increased to 22% in 2013 and to 23% in 2014, and we may see other changes to the VAT system. We can also expect changes to the rates of CGT and CAT and the abolition or restriction of related reliefs. A site value tax or property tax is on the way, while carbon tax, VRT and road tax are all set to rise as well. Eventually, just about every taxpayer will see their tax bill rise considerably over the next couple of years.
Hello, I'm John Fisher and I'm going to run through some of the main changes to business tax. First, the good news. As expected, there is no change at the corporation tax rate, which remains at 12.5%, notwithstanding the pressure from some of our EU counterparts. This low rate, together with the R&D tax credit, are the cornerstones of Ireland's corporate tax regime. The BES, or Business Expansion Scheme, is to be replaced by the Employment and Investment Incentive Scheme, subject to approval by the EU Commission. Companies will be able to receive injections of capital of up to €10 million, 5 times the current limit of €2 million. The annual limit will be €2.5 million, up from the old BES limit of €1.5 million. The increased investment limits will be welcomed, particularly by SMEs, the lifeblood of the economy. Capital allowances of 100% have been available to companies buying energy efficient equipment, and the Minister has extended this scheme for another 3 years, to the end of 2013. As set out in the 4-year National Recovery Plan, a number of business tax reliefs are being done away with. The patent relief was top of the list and has been abolished. Another change relates to loans taken out by people to buy shares in or lend to a company. Up to now, they could get a tax deduction on the interest paid on that loan. This relief is being abolished too, although the Minister did not expand on the specifics of how this would work. People have been able to claim this relief if they are not heavily involved in the company or own more than a 5% shareholding, and I expect it is this particular facet of the relief that is being targeted. In another change, employees will no longer get relief when investing in new shares of a company, nor will they be exempt from income tax in respect of share option plans. We'll have to wait for the Finance Bill before learning the extent, if any, of the transitional measures in relation to the abolition of the reliefs. The 3-year corporation tax exemption for start-up companies commencing a new trade has been extended to 2011, but the relief will now be linked to the amount of employers' PRSI paid by the company. This aims to encourage new companies to create employment. The Minister has also extended the Employer Job PRSI Expansion Scheme to 31 December 2011. Under this scheme, employers are exempt from paying PRSI for some or all new employees for their first year. On the downside, as Rory said, employers will now have to pay PRSI on half of all pension contributions they make. Among the other changes introduced in today's budget, subscriptions to professional bodies will no longer be tax deductible, and there are changes to RCT withholding tax in certain circumstances. As expected, however, there is no increase in the current VAT rate of 21%. I will now hand you back to Rory for his closing comments. Thank you.
So there we have it, the start of a 4-year plan, and is it, as we all hope, a cunning plan? There's great cause for concern in the burden that is being passed onto the business community and the taxpayers from that community, both employers and employees. Maybe the government has been very wise in deferring the planned increases in VAT until 2013, as it may find the ability of its taxpaying community to spend will have been severely restricted. As ever, FGS and its tax team are here to deal with any queries or questions you have about Budget 2011. Thank you for your time.